The forensic mindset. You've been training for this. You know that feeling when your DoorDash total is $23 but your bank shows $31.50? That instant detective mode you enter, scrolling through every fee, every tip, every mysterious service charge? That's forensic accounting. You're not learning something new today. We're weaponizing something you already do. Every time you've caught Ticketmaster adding fees that weren't there 30 seconds ago. Every time you've screenshot your Uber fare before the ride ends because you know they're about to change it. You've been practicing professional skepticism. See, forensic accounting isn't about learning to be suspicious. You already developed that when Netflix raised prices mid-pandemic while we were all locked inside. It's about channeling that natural skepticism into systematic methodology. You're already investigators in your daily life, tracking who hasn't Venmo'd for brunch, who's been forgetting their card for 3 weeks straight. Today, we're taking that investigative instinct and applying it to corporate financial statements. According to the Association of Certified Fraud Examiners, every organization loses approximately 5% of revenue to fraud annually. To know accounting, you must do accounting. But to know forensic accounting, you must think like both the perpetrator and the investigator. Today, we're examining both perspectives, because comprehensive understanding requires seeing the complete picture. Lock in. We're about to learn how money disappears and, more importantly, how to make it reappear. The foundation, the fraud triangle. Before we dive into specific schemes, let's establish our theoretical framework. Fraud isn't complicated, it's just betrayal with documentation. Think about it like you're streaming passwords. You share your Netflix with someone? That's trust. They change your password 3 months after you stop talking while still using your account? That's fraud. The only difference between personal betrayal and corporate fraud is the dollar amount and whether it falls under federal jurisdiction. The fraud triangle, developed by criminologist Donald Cressy, has 3 essential elements: pressure, opportunity, and rationalization. It's like your friend who starts selling their class notes. Pressure, rent's due. Opportunity, they're in every lecture. Rationalization, the professor posts everything online anyway. Before you know it, they're running a whole underground study guide empire. Same psychology applies whether we're talking about $5 or $5 million in embezzlement. Here's what forensic accounting teaches us. The system is designed with inherent vulnerabilities that create opportunities for those with access. The same structures that enable efficient business operations also enable sophisticated theft. Every internal control we implement is an admission that without it, someone would exploit that weakness. Think about that. Every signature requirement, every approval process, every audit trail exists because somebody, somewhere, proved we needed it by stealing first. The hierarchy of theft. Occupational fraud classification. Let me paint you a picture of how money walks out the door. It's like a party where everyone's trying to leave without paying their share of the Uber. Some people ghost before the check comes, that's skimming. Some wait until everyone's paid, then pocket the cash meant for the driver, that's larceny. And some convince everyone they already paid when they didn't, that's fraudulent financial reporting. In the corporate world, we call this the occupational fraud tree, and it branches out systematically. At the root, you've got asset misappropriation, which accounts for 86% of all fraud cases. This branches into cash schemes and non-cash schemes. Cash schemes divide into skimming, cash larceny, and fraudulent disbursements. Each category represents different methodologies, different red flags, and different detection strategies. Warren Buffett once said, "It takes 20 years to build a reputation and 5 minutes to ruin it." In forensic accounting, we study those 5 minutes with scientific precision. We dissect them. We learn the patterns so well we can identify them proactively. Because here's the reality, every company has some level of fraud occurring. The only question is whether they've detected it yet. And after today's lecture, you're going to know exactly where to look. Skimming. Theft of unrecorded revenue. Skimming is theft of cash before it enters the accounting system, like deleting a Venmo request before your roommate sees you received it. You can't steal something that never existed in the books, right? Wrong. This is what we call off-book fraud. the money that disappears before it even becomes recorded revenue. It's like when you're working that campus coffee shop job and a customer pays cash for their $7 specialty drink, but you ring it up as a $3 regular coffee and pocket the difference. The register's balanced, the customer's satisfied, and you just made $4 that technically never existed in the accounting records. But here's where it gets interesting from an audit perspective. Skimming is called off-book fraud because it happens before recording, but really it should be called blind spot fraud. Because in 2024, with comprehensive surveillance systems and point-of-sale analytics, the real skill isn't taking the money, it's taking it where the data trail doesn't lead. Every skimming scheme is essentially exploiting gaps in the control environment. You know what's fascinating from an internal control standpoint? We'll install a $2,000 security system to protect a $50 cash drawer, but we'll give the same employee we don't trust with the Wi-Fi password complete autonomy over cash sales. Make it make sense. Companies will conduct background checks for inventory positions, but won't implement basic cash reconciliation procedures. The security measures are selective, and that's exactly what perpetrators count on. Sales skimming, unrecorded transactions. Sales skimming occurs when the economic transaction happens, but the accounting recognition doesn't. It's like when you sell your textbook to another student for cash instead of going through the official bookstore buyback program. The book changed hands, money changed hands, but as far as any accounting system knows, nothing happened. In the corporate world, this is where cash becomes invisible, where sales become undocumented, where revenue takes unauthorized detours. Let me break down the classic unrecorded sales scheme from an accounting perspective. You make a sale, collect the payment, but never enter it into the point-of-sale system. It's elegantly simple, like your friend who forgets to scan items at self-checkout. The customer gets their product, you get the money, and the register. The register reflects lower sales volume. This works especially well in cash-intensive businesses where customers don't expect receipts. Think about it. When's the last time you asked for a receipt at a food truck? Exactly. That could represent 30% of undocumented sales. The no-sale function on registers was designed for making change without a transaction. But perpetrators exploit legitimate functions for illegitimate purposes, like how Instagram stories were designed for temporary posts but became primary communication channels. That no sale button becomes a skimmer's tool. Open the drawer, take the cash, close it up. The register shows no transaction, but cash has changed hands. Peter Drucker said, "What gets measured gets managed." Skimmers operate on the inverse principle. What doesn't get measured gets misappropriated. Check skimming, sophisticated redirection. Check skimming demonstrates where creativity meets criminal activity. It's not sufficient to just take money anymore. You need elaborate deception. Like creating a fake Venmo account with a name one letter off from your landlord's. People see what they expect to see. You're expecting to pay Professional Services LLC. You won't notice when the check goes to Professional Services LLC without the second "as." That missing letter? That's worth thousands in misdirected payments. The shell company scheme is essentially corporate identity theft. You create a company that sounds like a legitimate vendor. If your employer uses Office Supply Solutions, you create OSI LLC or Office Solutions Inc. It's like how every college town has multiple pizza places with similar names and nobody knows which one's the original. Checks arrive, you deposit them, and everyone thinks they paid the correct vendor. It's organizational deception at scale. Here's the double meaning that captures it perfectly. These perpetrators aren't just taking checks. They're removing checks and balances from the equation. They're writing checks their ethics can't cash, but their bank accounts definitely can. The sophistication level in modern check fraud is remarkable. We're not talking about simple check alteration anymore. We're talking about entire parallel universes of fake vendors, complete with websites, phone numbers, and customer service operations that might be more responsive than legitimate vendors. After-hour sales, temporal exploitation. After hours, sales schemes happen when official operations cease, but unofficial operations commence. It's like when your barber cuts hair in his apartment after the shop closes. Same skills, same service, but the revenue stream is redirected. In legitimate business, this is when employees convert company customers into personal clients. The business is closed, but they're using company resources, company space, and company reputation to generate personal income. Consider your campus gym from an accounting perspective. Closed at 10 p.m. officially, but the night employee is conducting personal training sessions until midnight, using the facility's equipment. They're charging $50 per hour, cash only, no documentation. The gym's liability insurance is covering them. The gym's utilities are powering them, but the gym's financial statements, not reflecting a penny. This is misappropriation of opportunity, wrapped in entrepreneurship. They're not just stealing money, they're stealing the entire business model. You know what's remarkable about this? Companies will install GPS tracking on fleet vehicles to monitor personal use, but they won't check if those same employees are running side businesses using company facilities. We're tracking the company car's trip to Walmart, but missing the fact that the warehouse is running a fulfillment center after hours. It's like having Ring doorbells on the front entrance, but leaving loading docks unmonitored. The technology exists, but the implementation is incomplete. Receivables skimming, payment interception. Receivables. Skimming involves intercepting customer payments, like your roommate claiming your food delivery before you know it arrived. The customer paid. The company's accounts receivable shows an outstanding balance, but that payment took a detour through someone's personal account first. This is sophisticated misappropriation, requiring both access and concealment skills. The sender thinks it was delivered. Accounting is wondering where it is, and someone else is depositing your check. The complexity here escalates because receivables exist as recorded assets in the accounting system. When you skim sales, you're taking money that was never recorded. But with receivables, the sale is recorded, the asset is recognized, the company is expecting collection. Now you've got to make that expectation disappear. It's like promising your parents you'll pay them back for spring break, then hoping they forget. Except companies have entire credit and collections departments dedicated to not forgetting. That's what makes receivables skimming require ongoing concealment. Let's talk about the perpetrator profile from a behavioral perspective. The person skimming receivables isn't usually new to the organization. They're someone who's been there long enough to understand every weakness, every blind spot, every moment when nobody's reviewing. They started as trusted employees, but somewhere between the denied promotion and the third year, without meaningful raises, trust became opportunity for exploitation. They know the system because they helped build it. That's the tragedy of occupational fraud. The best forensic accountants will tell you, it's rarely strangers who steal. It's the people who know exactly how much they can take before anyone notices. Lapping, the perpetual concealment scheme. Lapping is robbing Peter to pay Paul, but Peter doesn't know he's been robbed, and Paul doesn't know Peter's payment covered his account. It's like using your friend's Netflix payment to cover your Hulu bill, then using another friend's Hulu payment to cover the first friend's Netflix. It's a payment shell game that works until someone wants to watch something and their account's suspended. In accounting, it's taking customer A's payment for yourself, then using customer B's payment to credit customer A's account, then customer C's to credit customer B, and so on, until you're juggling more payments than a subscription management app. This scheme requires two things: access to payments and exceptional organizational skills. You need access to incoming receipts and memory, like a chess grandmaster remembering positions, because one mistake, one payment credited to the wrong account, and the whole house of cards collapses faster than a cryptocurrency exchange. The perpetrator is literally living payment to payment, but not their own payments, everyone else's. They're running parallel accounting records that would make enterprise resource planning systems crash. Here's the critical insight about organizational culture. Lapping only works in organizations that trust too much and verify too little. It's enabled by the assumption that people are good, which is philosophically admirable, but operationally dangerous. When companies say, "We're like a family here," What they often mean is, we don't have proper segregation of duties. Because real families, they know exactly who's most likely to take money from the cookie jar. The mysticism of human nature is that we want to believe in goodness so badly that we create systems that inadvertently reward those who exploit our faith. Force balancing, fictional reconciliation. Force balancing is making the numbers work through manipulation and creative journal entries. It's like when your checking account shows negative $40, but you need it to show positive 10 for that automatic payment tomorrow, so you transfer funds knowing you'll figure it out later. Except in corporate fraud, figuring it out later means doctoring the books until reality bends to match your fiction. The person doing force balancing typically has both collection and recording responsibilities. That's like letting the same friend who owes you money also keep track of how much they owe. The conversation goes, "How much do I owe you?" "Nothing. We're good." "But I borrowed." "Nah, we're good." The books balance because they force them to, like cramming your overpacked suitcase shut. Everything looks fine from the outside, but open it up and chaos explodes everywhere. You want to know something remarkable? Force balancing is literally forcing equilibrium where disequilibrium exists, like calling your relationship complicated when it's really just dysfunctional. The numbers don't lie, but the person entering them absolutely does. They're creating mathematical fiction, crafting narratives that would make creative writers jealous. A balanced ledger hiding complete chaos underneath. It's like having a perfect GPA, but you haven't attended class all semester. The grades look right, but the substance is missing. Fraudulent write-offs, concealment through deletion. Fraudulent write-offs are the accounting equivalent of deleting incriminating messages before anyone sees them. Something existed, now it doesn't, and you're hoping nobody asks questions. When someone steals receivables, they need to make that missing money disappear from the books too. So they write it off as uncollectible, like declaring that friend who owes you money has officially ghosted you forever. The debt disappears from the books, the theft is concealed, and the balance sheet balances. This works especially well in companies with historically high bad debt rates, like those buy now pay later companies that expect certain default percentages. If the company expects 5% defaults and someone's stealing 3%, who's going to notice the 8% actual rate? It's hiding in plain sight, like wearing AirPods during an exam. Technically visible, but nobody's checking. The fraudster becomes a magician, making receivables disappear with write-off authorization. Here's the observation that'll make you think. Companies will spend thousands on credit checks for new customers, but won't audit who's writing off the bad debt. We're so focused on preventing accounts from going bad that we forget to monitor who's declaring them dead. It's like having security at the front door, but letting anyone decide who leaves through the back. The same employee who couldn't get approved for a $100 purchase order has the authority to write off thousands in receivables. The irony is overwhelming. Destroying records, evidence elimination. Destroying records is the fraud equivalent of clearing your browser history, except instead of hiding your late-night shopping, you're hiding theft. It's the ultimate "pics or it didn't happen" defense. No documentation, no crime. Like when your roommate swears they paid their share of utilities but conveniently can't find any record. In the corporate world, this is when documents mysteriously disappear, files get corrupted, and servers somehow crash right when the auditors arrive. The beauty of destroying records from a perpetrator's perspective is that it creates reasonable doubt. Without documentation, everything becomes testimonial, and in accounting, that means nothing's proven. It's like trying to prove you returned that rental textbook when the confirmation email mysteriously vanished. You know you did it, they say you didn't, but without proof, you're absorbing that charge. The fraudster who destroys records isn't just stealing money. They're stealing the ability to prove they stole money. But here's the technical reality for 2024. Destroying records isn't about shredding papers anymore. It's about knowing which emails to delete, which backup servers to corrupt, which audit trails to interrupt. These aren't criminals with matches, they're criminals with administrative access. They're not burning books. They're editing history in real time. Like how your iPhone secretly keeps deleted photos for 30 days. Corporations think they have redundant backups. But the sophisticated fraudster, they know where every copy lives and how to eliminate them all simultaneously. It's not destruction, it's systematic evidence elimination. Cash larceny, theft after recording. Cash larceny is stealing money after it's been recorded in the books, which is like taking money from the group Venmo after everyone can see the transaction. It's bold, it's brazen, and it requires either incredible stupidity or incredible creativity to conceal. The money was counted, documented, entered into the system, and then someone said, "But what if it wasn't?" This is theft with an audit trail, like robbing a bank but signing the withdrawal slip. The difference between skimming and larceny is timing relative to recording. Skimming happens pre-recording. Larceny happens post-recording. It's like the difference between ghosting someone before the first date versus after a 3-year relationship. One leaves no trace, the other leaves extensive documentation. Larceny requires not just taking the money, but explaining where it went. That's where the creative accounting comes in. Here's the human element that matters. Most people who commit cash larceny aren't career criminals. They're employees who've been there long enough to know when nobody's watching. They've observed every control weakness, every checkpoint, every audit process. They know the 30-second window between when cash is counted and when it's deposited. They know which supervisor never actually supervises. They're not learning the system to beat it. They learned the system doing their job, then realized they could beat it. That's the heartbreak of internal fraud. It's expertise weaponized against trust. Point of sale larceny. Register manipulation. Point of sale. Larceny is like being the DJ at a party and pocketing the cover charge meant for the venue. You're right there where the money is, with legitimate access, but you're redirecting the flow. The register is open for business, but some of that business becomes personal. It's theft in real time, while customers are watching, while cameras are recording, while managers are supposedly managing. The audacity is astronomical. The classic scheme is the false void. Ring up a sale, customer pays, then void the transaction after they leave and pocket the cash. It's like accepting an electronic payment, then claiming your account never received it. The customer has their product, they're satisfied. The register shows a void, which happens legitimately all the time. And you've got undocumented income. It's beautiful in its simplicity, exploiting normal business operations for abnormal purposes. But check this technical breakdown. Modern POS systems track everything: timestamp, employee ID, void frequency, even drawer open duration. But you know what they don't track? Intent. The system can't differentiate between a legitimate void because the customer changed their mind and a fraudulent void because the employee changed their ethics. That's the gap. That's the vulnerability. Every control we create is just a speed bump, not a roadblock. The determined perpetrator doesn't stop, they just get creative with their route. Death by 1,000 cuts. Cumulative microtheft. Death by 1,000 cuts is stealing so little, so often, that nobody notices until it's too late. It's like streaming services charging you $12.99 instead of $9.99, and hoping you won't check your statement. $3. Who's investigating $3? Nobody. But $3 from 1,000 customers every month. Now we're talking about significant misappropriation. This is theft through patience, fraud through frequency. In retail operations, this looks like taking $5 from the register every shift. Not 50, not 500, just 5. It's less than a coffee drink, less than what falls between your car seats. Who's going to notice? But $5 a shift, 5 shifts a week, 50 weeks a year. That's $1,250 annually. That's rent money. That's meaningful theft, disguised as immaterial amounts. It's the corporate equivalent of your roommate taking one slice of your pizza every time. By the time you notice the pattern, the whole pie is gone. Here's the emphasis that matters. This is the theft nobody sees. This is the theft nobody reports. This is the theft nobody investigates. Because who's going to risk their job accusing someone of taking $5, the investigation would cost more than the theft. That's the genius from the perpetrator's perspective. It's not just that it's small, it's that it's smaller than the cost of caring. Warren Buffett said, "Someone's sitting in the shade today because someone planted a tree a long time ago." These perpetrators aren't planting trees, they're taking seeds, one at a time, until the whole forest is theirs. Deposit lapping, temporal manipulation. Deposit lapping is playing with time like manipulating when you deposit checks to float your account balance. It's using the gap between collection and deposit to cover your tracks. In fraud terms, it's taking today's deposit to cover yesterday's theft, then using tomorrow's to cover today's. It's a temporal shell game that requires predictable cash flows. The perpetrator here is banking on consistency, literally. They know it takes 3 days for corporate to notice a missing deposit, so they take Monday's deposit for themselves, then use Tuesdays to cover Monday, Wednesdays to cover Tuesday. As long as money keeps coming in, the music keeps playing. It's like paying your credit card with another credit card. It works until it catastrophically doesn't. You want that strategic insight? Deposit lapping only works in companies with predictable cash flow patterns. The perpetrator needs certainty that money's coming tomorrow to cover what they took today. That's why this happens in subscription businesses, parking operations, any place where revenue is reliable. They're not gambling, they're calculating based on historical patterns. They're not hoping for tomorrow's money. They're counting on it with statistical confidence. These perpetrators aren't just stealing deposits, they're running a parallel cash management system. Non-cash misappropriation, asset theft. Non-cash misappropriation is theft of tangible assets instead of cash, and let me tell you, inventory is easier to steal than money. It's like the difference between trying to sneak cash from your parents' wallet versus taking snacks from the pantry. One triggers immediate investigation, the other might go unnoticed for weeks. Companies guard their cash with sophisticated controls, but leave their inventory relatively unprotected. The warehouse has fewer controls than a retail cash register. This is where employees get creative with their compensation packages. Can't get a raise? Supplement with office supplies. Passed over for promotion? That equipment looks portable. Company won't pay for your certification? These training materials are now yours. It's self-administered compensation adjustment, unauthorized benefits administration. The employee becomes their own HR department, approving benefits the company never offered. Here's the observation that reveals the contradiction. Companies will run comprehensive background checks, going back years, but then give the same employee unsupervised access to warehouses worth millions. Will drug test someone to work retail, but then trust them alone with all the inventory. The security measures are weirdly selective. It's like putting a sophisticated lock on your diary, but posting all your business on social media. The contradiction is so obvious it becomes invisible. The misuse continuum, temporary versus permanent. Misuse versus larceny is the difference between borrowing your roommate's charger and selling it on Facebook Marketplace. One's inappropriate, the other's criminal. In the corporate world, misuse is using company resources for personal benefit, but with the intention or pretense of returning them. It's the gray area where ethics erode gradually. The laptop comes home for remote work, but streams Netflix. The company car drives to client meetings that happen to be near your gym. The psychology here is fascinating from a behavioral standpoint. Employees who would never steal cash will absolutely use the company printer for personal projects. They'd never take money from the register, but will absolutely run their side business using company software. It's like those people who would never shoplift, but will absolutely take extra condiments. The mental gymnastics are Olympic level. It's not stealing, I'm just maximizing my resource utilization. But here's the progressive nature of the problem. Misuse is the gateway to misappropriation. It starts with staying 5 extra minutes on break, then taking home some supplies, then borrowing equipment, then running your whole side business from the office. The progression is so gradual you don't notice you've crossed the ethical line until you're selling company property online. Every major fraud started with minor violations that normalized over time. False sales, theatrical theft. False sales schemes are when employees pretend to sell inventory to accomplices who pretend to buy it. It's like those social media giveaways where influencers give away products to their friends who act surprised. Everyone's acting, nobody's actually purchasing. The inventory leaves through the front door with complete documentation, receipts, invoices, shipping papers. The only thing missing? Actual payment. The accomplice could be anyone, a friend, family member, or just someone who wants discounted merchandise. They walk in, purchase items, walk out. The employee processes it as a legitimate sale, maybe even at a discount. Later, that sale gets written off as bad debt. The merchandise is gone, the payment never existed, and the books show a normal transaction that went bad. It's like getting a full refund on something you never paid for. The audacity is admirable if it wasn't criminal. Here's the punchline for you. These employees aren't making sales, they're making tales, fictional narratives for the books that'll never reconcile. They're writing fiction in the accounting department, creating characters, fake customers, plot lines, fake sales, and endings, write-offs, that would make screenplay writers jealous. The only problem? This series always ends with termination and potential prosecution, not award nominations. False shipments, logistical deception. False shipments are like ordering something online, claiming it never arrived, but you're both the seller and the buyer. The employee creates shipping documentation for inventory that gets delivered to fake customers or real addresses where accomplices wait. It's drop shipping, but what's dropping is ethical standards, and what's shipping is stolen inventory. The paperwork's perfect. The process looks legitimate, but the payment, that's complete fiction. This scheme requires coordination like planning a group project where everyone actually has to participate. You need someone inside creating documents, someone outside receiving goods, and sometimes someone in shipping who looks the other way. It's organized deception requiring multiple participants. The inventory system shows items were sold and shipped, accounting shows a receivable, and months later when nobody pays, it gets written off as bad debt. The long con in action. You know what's remarkable about the documentation aspect? The documents we create to prevent fraud become the tools to commit it. Every control is also a blueprint for circumvention. The shipping manifest that proves delivery also enables fake delivery documentation. The customer database that verifies buyers also hosts the fictitious ones. We're not just studying accounting, we're studying how legitimate processes can be weaponized for illegitimate purposes. Write-off manipulation. Disguised disposal. Write-off schemes are like deleting your mistakes from existence, except the mistakes are thefts. When inventory gets stolen, it needs to disappear from the books too. So the perpetrator declares it damaged, obsolete, or mysteriously missing. It's selective amnesia applied to accounting records. The inventory that walked out the back door gets officially declared unsaleable, case closed, no investigation needed. The beauty of this scheme from a perpetrator's perspective is it uses legitimate business processes. Every company writes off some inventory. Products expire, get damaged, become obsolete. It's normal, expected even. So when someone adds their theft to the legitimate write-offs, it's like hiding a tree in a forest. Who's going to question why we wrote off $10,000 in inventory when we write off $8,000 every month anyway? It's that extra $2,000 that nobody notices. Statistical noise in the data. Here's the human element. The person doing this isn't usually senior management. It's the warehouse worker who's been there 5 years without meaningful advancement. It's the inventory clerk who trains new hires but never gets promoted. They know exactly how much the company writes off monthly, quarterly, yearly. They know the acceptable loss tolerances. They're not greedy, they're strategic. They take just enough to stay under the radar, like keeping your phone brightness just low enough that nobody notices you're not paying attention. The tragedy is, they're usually good employees who decided to compensate themselves for what they believe they deserve. Physical padding, inventory illusions. Physical padding is making it look like inventory exists when it doesn't. It's like those social media posts showing luxury lifestyles that are completely staged. Empty boxes stacked high, warehouse sections marked as restricted, Excel sheets showing thousands of units that exist only in formulas. It's corporate illusion, making the company look healthier than reality. This isn't just about hiding theft. Sometimes it's about hiding operational failure. Maybe sales are down, inventory's not moving, but you need to show growth for the quarterly earnings report. So you create phantom inventory, ghost products that haunt the warehouse. During the audit, you point to the sealed boxes, the restricted areas, the impressive spreadsheets. The auditors, pressed for time, check the boxes about checking the boxes. It's like keeping your gym membership just to say you have one, the appearance of assets without the reality. But here's the technical evolution. Physical padding in 2024 isn't just empty boxes anymore. It's sophisticated digital manipulation, fake RFID tags that register non-existent inventory, doctored photos showing full warehouses, manipulated database entries. We're not talking about putting bricks in a box anymore. We're talking about creating entire virtual warehouses that auditors review remotely. The technology to verify has evolved, but so has the technology to deceive. It's an arms race where both sides have sophisticated weapons. Segregation of duties, structural fraud prevention. Segregation of duties is like requiring two keys to launch critical operations, because nobody should have complete unilateral control. It's the corporate equivalent of requiring multiple signatures on important documents. One person authorizes transactions, another processes them, a third records them, and a fourth reconciles. It's intentional inefficiency designed for security, because the alternative, letting one person control everything, is how you end up as a fraud case study. Think about your group projects. Ever notice how the person who volunteers to handle everything either wants complete control or plans to do nothing? Same principle in business. When someone says, "I'll just take care of all the purchasing to make it easier," alarm bells should ring. They're either inefficient or innovative. And by innovative, I mean innovative ways to misappropriate. It's like letting the same person be referee and player, banker and gambler, judge and defendant. The conflict of interest isn't potential, it's guaranteed. Here's the systematic insight. Every fraud story starts with, "They were so helpful." The employee who stayed late to reconcile accounts, who volunteered for extra duties, who knew every aspect of the system. They weren't learning to help, they were learning to harvest. Peter Drucker said, "Management is doing things right. Leadership is doing the right things." Segregation of duties ensures that even if someone wants to do the wrong things, they can't do them alone. It's forced collaboration for fraud prevention. Data analytics, algorithmic fraud detection. Data analytics in forensic accounting is like social media algorithms knowing your preferences before you do. The numbers tell stories you didn't know they were writing. That employee who never takes vacation? Red flag. They might be maintaining a fraud scheme. The vendor who always bills just under the approval threshold? Red flag. They understand your controls. The accounts that only get adjusted at month end? Red flag parade. It's pattern recognition at scale, finding needles in haystacks by understanding how needles behave differently than hay. Modern analytics can spot fraud like streaming services, predict your viewing preferences, eerily accurate and slightly invasive. It knows that Sally from accounts payable processes invoices 20% faster on Fridays, except for 3 vendors who take twice as long. Why? The system doesn't know why, but it knows something's different. It's like how your phone's screen time analytics knows you're procrastinating before you do. The data doesn't lie, it doesn't forget, and it definitely doesn't take bribes. But here's the technical arms race that's developing. The same analytics that catch fraud inadvertently teach fraud. Every pattern we identify becomes a pattern to avoid. It's like how every true crime documentary is inadvertently a tutorial on what not to do. The perpetrator of tomorrow is studying the analytics of today, learning what triggers alerts, what raises flags, what patterns to avoid. It's an evolutionary competition where the prey is learning from the predator's tools. We're not just teaching detection, we're inadvertently teaching better deception. The Fraud Triangle in 2024. Modern pressures. Let's revisit the fraud triangle with contemporary context. Pressure isn't just financial anymore, it's comprehensive. Student loans that resemble mortgage payments, rent consuming 60% of income, healthcare costs that force impossible choices. The pressure isn't subtle, it's suffocating. It's not, I want a boat, it's, I want to not check my bank balance before buying groceries. The American dream became the American debt, and that's the pressure creating potential perpetrators. Opportunity in the digital age has exploded exponentially. Remote work means less supervision. Cloud systems mean access from anywhere. Digital payment systems mean new attack vectors. The opportunities aren't just present, they're multiplying faster than we can control them. Every new technology designed to facilitate business also facilitates fraud. It's like how every app that promises to simplify your life also complicates your privacy. The opportunity isn't knocking anymore, it's kicking down doors. Rationalization is where it gets psychologically complex. The company made record profits but gave 2% raises. The CEO makes in an hour what I make in a year. They waste more on corporate retreats than I'm taking. The rationalization isn't just personal anymore, it's systemic. It's like how we all justify using ad blockers on sites we visit daily. The rationalization is prepackaged, societal, almost encouraged. When inequality becomes extreme, fraud becomes rationalized as rebalancing. Artificial intelligence, the future of forensic accounting. Artificial intelligence in forensic accounting is like having a security system that learns behavioral patterns better than humans can observe them. It's not just monitoring for fraud, it's predicting it. Like how TikTok's algorithm knows what video will keep you scrolling, forensic AI identifies which employee behaviors correlate with fraud risk. It's predictive analytics applied to human behavior, catching fraud before it fully manifests. These systems analyze everything comprehensively: email sentiment analysis, badge swipe patterns, mouse movements, even typing cadence. It identifies when behavior changes, when patterns shift, when risk increases. The employee who suddenly starts accessing unfamiliar systems. Flag. The accountant whose typing pattern changes when entering certain transactions. Flag. The manager who logs in at unusual hours. Flag. It's behavioral surveillance applied to fraud detection. But here's the double-edged sword. The more sophisticated our detection becomes, the more sophisticated fraud becomes in response. It's like antibiotic resistance creating superbugs. We're not eliminating fraud, we're evolving it. The perpetrator of 2030 won't just know accounting, they'll understand machine learning. They won't just doctor books, they'll potentially train AI to doctor them better. We're in an arms race where both sides are getting smarter, faster, more sophisticated. The future of fraud isn't human versus machine, it's human with machine versus human with machine. The true cost of fraud beyond financial impact. The cost of fraud isn't just financial, though the financial impact is staggering. Approximately 5% of global GDP annually. That's trillions of dollars. But the real cost? Trust destruction. When fraud happens, every process gets slower. Every transaction needs more approval. Every employee faces increased scrutiny. It's like how one person sneaking prohibited items causes everyone's bags to be searched. The many suffer for the actions of the few. Think about what fraud does to organizational culture. Suddenly everyone's a potential suspect. That collaborative environment, gone. That flexible work arrangement, restricted. That trust-based culture, now it's verification-based. It's like when someone shares private information from the group chat, so now everyone's paranoid about what they share. Fraud doesn't just steal money, it steals culture. It turns coworkers into suspects, processes into interrogations, meetings into depositions. Here's the human truth that matters. The hardest part about fraud isn't the theft, it's the betrayal. It's finding out the colleague you had lunch with every day was stealing while you ate. It's discovering the mentor who taught you everything also taught themselves how to embezzle. It's like finding out a relationship was built on lies, but instead of losing love, you're losing livelihoods. Companies don't just lose money to fraud, they lose innocence. Once you've been burned, you never trust the same way again. Prevention, strategies, building resilient systems. Prevention is like cybersecurity for financial assets. You're never fully protected, just harder to victimize than other targets. It starts with tone at the top. If leadership demonstrates ethical flexibility, everyone else will too. It's like when the professor says attendance is optional, then wonders why nobody shows up for lectures. The ethics of an organization flow from leadership. If executives are manipulating expense reports for personal benefit, don't be surprised when employees manipulate timesheets. Controls need to be practical and sustainable, requiring excessive approvals for minor purchases. People will split transactions to avoid them, making passwords change weekly. People will write them down, defeating the purpose. The best control is sustainable and realistic. Otherwise, people don't break the rules, they break the control system itself. Here's the economic reality to consider. Prevention isn't about eliminating all fraud. It's about optimizing the cost-benefit equation. Every control costs money, time, and efficiency. At some point, preventing the last percentage of fraud costs more than accepting it. It's like spending $50 on security for a $10 item. The goal isn't zero fraud, it's optimal fraud prevention, the level where preventing more would cost more than the fraud itself. That's not cynical, that's resource allocation. As Warren Buffett says, price is what you pay, value is what you get. Sometimes perfect prevention isn't worth the price. Integration and synthesis, the complete picture. Everything we've examined today connects systematically. Skimming, larceny, misappropriation. They're not isolated schemes. They're different instruments in the fraud orchestra. The employee who starts by skimming sales might graduate to lapping receivables, then advance to write-off manipulation. It's progression, like how streaming service subscriptions multiply over time. The fraud evolves as the perpetrator gains confidence and expertise. The patterns are predictable once you understand the indicators. Like how every toxic relationship has similar red flags, every fraud scheme has tells. The employee who never takes vacation, they can't let anyone else see their work. The vendor who always bills just under approval limits. They understand your controls. The inventory that's always short but never investigated. Someone's comfortable with the status quo. These aren't coincidences, they're breadcrumbs. Follow them and you find the fraud. But here's the real integration, the moment where knowledge becomes power. Understanding fraud isn't about becoming paranoid, it's about becoming aware. It's like learning defensive driving. You don't fear every vehicle, but you watch for dangerous drivers. You don't suspect everyone, but you recognize suspicious patterns. You're not trying to catch fraud, you're trying to prevent it. Because the best fraud is the one that never happens. The best thief is the one who never steals. The best control is the one that makes people choose honesty, not from fear, but from culture. Your role in the solution, becoming a guardian. After 30 slides, you're not the same student who walked into this lecture. You've seen behind the curtain, learned the methodologies, understood the psychology. You know how money disappears, and more importantly, how to prevent it from disappearing. You're like someone who's learned to see the matrix of financial deception. The knowledge you have now makes you valuable to every organization. You're not just accountants anymore, you're guardians of financial integrity. This isn't just about catching perpetrators, it's about creating systems where good people stay good. Because here's the truth nobody talks about. Most fraudsters aren't career criminals who infiltrated companies. They're good employees who rationalize bad decisions. They're people who started honest but became bitter, broke, or bold. The system we build either protects these people from themselves or pushes them toward theft. That's the responsibility that comes with this knowledge. To know accounting, you must do accounting. But to know forensic accounting, you must think, like both criminal and cop, understand both temptation and prevention, see both opportunity and control. You're not just learning to count money, you're learning to protect it. You're not just balancing books, you're balancing ethics. You're not just preventing fraud, you're preserving trust. And in a world where trust is increasingly rare, That makes you invaluable. The career proposition, your professional advantage. Let me present the empirical reality about your career prospects. While your business major peers compete with 50,000 graduates for the same entry-level positions, forensic accountants are being recruited aggressively. You know why? Because every company, every nonprofit, every government agency, every entity that handles money needs someone who can protect it. And after today, that's you. Here's the observation that should reshape your career planning. Companies will pay premium salaries to recent graduates who understand fraud prevention and detection. Think about that. Your friends grinding through unpaid internships hoping for $45,000 starting, while forensic accounting firms are offering $70,000 plus signing bonuses to anyone who understands the fraud triangle and can apply it. The FBI recruits forensic accountants harder than almost any other specialty. The IRS Criminal Investigation Division maintains the highest conviction rate in federal law enforcement, and they're all accountants. While everyone else worries about automation replacing their jobs, AI is making forensic accountants more valuable because someone needs to audit the algorithms. The economic resilience of this career path is remarkable. In economic expansions, companies need forensic accountants to ensure growth is legitimate. In recessions, they need them to find efficiency and eliminate fraud. In crises, they need them to investigate failures. You're not choosing a major, you're choosing perpetual demand. Your LinkedIn won't have recruiters, it'll have executive search firms. Companies don't post forensic accounting positions publicly. They poach people who have them. You could be creating content hoping for brand deals, or you could be the person companies pay 6 figures to investigate their influencer marketing fraud. You could be grinding in consulting, making presentations nobody implements, or you could be the forensic accountant whose report changes corporate governance. You could be another business graduate with generic skills, or you could be the specialist everyone needs but few become. When the economy tanks, companies eliminate marketing, reduce sales forces, flatten management. But forensic accountants, we become more valuable because fraud historically increases during economic stress. When trust erodes, we become essential. When failures occur, we become indispensable. You're not just recession-proof, you're recession-profitable. That's not a career, that's a strategic advantage. Lock in. The choice is yours. But after what you learned today, how could you choose anything else? Closing reflection. Today, we traced the complete anatomy of occupational fraud from skimming to sophisticated schemes, from simple larceny to complex concealment. We've examined behavioral patterns, systematic vulnerabilities, and control mechanisms. You're walking out with more than knowledge. You're walking out with perspective. X-ray vision for financial statements, pattern recognition for suspicious transactions, investigative skills that make you invaluable. Remember, the numbers tell stories, but sometimes those stories are fiction. Your job is to find the truth. The profession needs ethical, systematic thinkers who understand that preventing fraud is as important as detecting it. That's you now. Dr. Fulmore out.